Active money managers just reached a 99% exposure rate to the US stock market. This is a level of exposure that we've only witnessed a handful of times over the last few years. This is an extremely relevant development for US stocks that we should be paying attention to, as it has just increased the probability of a rug pull occurring on US stocks. And this is going to be a short, quick update for you guys on YouTube so you can also weigh in this risk properly in your trading. Now, this is an index called the NAAIM Exposure Index, and it gives us an indication of how exposed active money managers on Wall Street are to the US stock market. Now, the vast majority of the time, we're not weighing in this information into our analysis. But when it gets to extreme levels like we're seeing today, that's when we pay very close attention to it, and we even make decisions based on this. Now, if we zoom out and we add the US stock market on top of this indicator, we can see that many of these extreme readings in fund manager exposure have occurred right before or right at very important peaks in the US stock market. Most of these being followed by around 5 to 10% pullbacks. There's a very good reason for why this happens on a systematic basis, and more importantly, why it's making the stock market vulnerable today. This is a chart of the S&P 500 priced in euros. When you compare it to the S&P 500 priced in dollars, you'll see there's a pretty wide gap between the two. This is something that we've pointed out in recent weeks, that a big chunk of the strong performance that we've had on the US stock market has actually been a result of a weak US dollar. And it is very visible on this chart. It almost looks like there's a pocket of air between the S&P 500 priced in dollars and the one priced in euros. And this is putting the stock market in a vulnerable situation, because as the S&P 500 index has risen in dollar terms, it has forced many players, many institutions back into the market to avoid missing out on returns. Because as the S&P 500 index has risen, not only has it forced institutions to increase their exposure to the US stock market, but it has also made stocks outperform every single other asset that institutions might have exposure to, naturally making them a bigger part of their portfolio, all the way to the point where fund managers have actually reached an exposure rate of 99% to US stocks. If these institutions suddenly perceive risk in the market and decide to cut down their high level of exposure, the selling pressure from this would likely result in a pullback. And we could be about to see a catalyst for this kind of rebalancing to occur. This is the chart of the US dollar index, which measures the performance of the dollar against other major global currencies. As you can see, it has declined considerably since the start of the year. And as mentioned earlier, this has helped propel the US stock market to all-time highs. If it had not been for this decline in the US dollar index, the S&P 500 would not have made new all-time highs. So if the dollar suddenly bounces here, it could trigger that kind of rebalancing from institutions that we just talked about. And today this is a real risk. If we overlay something called the break-even inflation rate on top of the US dollar, we see exactly what drives the US dollar's performance. Inflation break-even rates basically tell us how the market is pricing in inflation at any given point in time. And this can have big implications on what the US Central Bank, the Federal Reserve, does. So the US dollar's strength varies depending on how the market is pricing in inflation. Now recently we've seen a divergence build between the dollar and the break-even inflation rate, and this could be setting the dollar up for a bounce. Now, I want to be clear, we are of the view that the US dollar will continue to weaken in the coming months under the current administration. But in the near term, the probability of the dollar bouncing here is quite high. The dollar is currently about 6% below its 200-day moving average, which is a very overextended level. We've only seen this level of overextension 4 times going back to 2017, and in all 4 cases, the dollar did bounce in the weeks that followed. Now, typically, we would not be concerned about a small bounce occurring on the US dollar. But today is a different story because fund managers have a 99% exposure rate to the US stock market. Now, I want to be clear, we're not going short on the market based on this. But our trading strategy at Bravos Research revolves around being exposed to stocks when we have a high degree of confidence that the market can actually move higher. Whenever we think there's too much risk to being exposed to the US stock market, we dial back our exposure. It could very much be that a week from now we'll have ramped back up our exposure to US stocks and that we'll be aggressively long on semiconductor stocks, for example. But as of now, we are being a little bit more careful with the trades that we're initiating. Our entire strategy is laid out in a lot more detail on our website, along with buy and sell alerts for all of the trades that we initiate. You can see all of our closed trades on our homepage by clicking on the link down below. I look forward to seeing you there. Thank you for watching.